So good morning, Saturday morning. So much going on, I don't know where to start. But today I kind of want to talk about the background stuff because of what's going to go down on Monday or what may happen on Monday. And I'm not going to sit here and talk about tariffs per se. I just want to say there's only one news item today on the tariffs. Out of Heard Island, Leonardo came out and said that they will no longer perform Happy Feet until Trump removes the 10% tariffs. So there you go. They're already coming back at us. So let's talk about what's going on in the markets though, and how we can read this, because there's some anomalies going on that really don't make a lot of sense. The most confusing one to me is the dollar and the bond. So here's our dollar index, and as you can see here, we were in a week before Trump took over, our dollar was over 109. And as you can see, it's at 102.69. It hit 101 something yesterday. No big deal, okay? We know that Trump has said he wants to drive down the dollar, or Bessent and Navarro, whatever. They want to drive it down. And so they have been driving down the dollar. And we know that the yen is up and the euro is up as people move out of the dollar. But that's not what's weird. This is a chart of the Treasury. It's literally almost exactly the same as the dollar. And it's almost on the exact same day that we were at 484 on our 10-year Treasury. And as you know, we hit 393, 4 on Friday, and now it's at 4%. So tell me this, I can't remember, and I'm not saying that I have all information at my fingertips here. When did the dollar go down while bonds went up? Because these are our rates coming down. That means the price is going up. So if people are selling the dollar, and they obviously are because it's going down, how are our bonds going up? So this anomaly, I can't explain it. I'm just pointing it out. If anyone has an opinion, I'd be more than glad to listen. So what's going on here? Now, this is what everyone's really worried about. They're saying that the hedge funds are facing Lehman-style margin calls, all right? And it raises the fear of a Black Monday. And we're going to talk about that now. So let's go back to the OMFIF article on the cash basis trade. This is where they state in here, and you can read right there in the middle, that the Fed believes that the hedge funds were leveraged, 20 or 22 times, okay? And remember, this OMFIF, these are the people who deal with the trillion-dollar asset managers, sovereign funds. These guys are big time, right? They went out and they talked to the hedge fund. And you can read right in there, in the middle, they say that the hedge funds are averaging 56 times leverage on Treasury repo borrowing. And there's another thing here I want to point out to you that is critically important. They say the leverage is coming from treasuries and from prime brokerage. Prime brokerage is our banks, okay? They have lent huge amounts of money into this trade. So what does this mean to us? So you got to think about something. You're a hedge fund. You have $1 billion, okay? We'll do round numbers, okay? $1 billion. And the first thing you do is you leverage your $1 billion up 56 times using treasuries. You do the cash basis trade. You leverage your money up 56 times. That's on average. That means that there are hedge funds out there with 100, 150 times leverage on their treasuries, okay? But now you still have the money, and you go out and you do all your investing out there, right? You buy stocks, you buy gold, you buy this, you buy that, whatever, right? And you're doing it with leverage, okay? So that's why all the brokerage firms, trust me, are racing around trying to figure out who they need to get more money from, because all these hedge funds are not stupid. Look at what Huang did, where he brought down Credit Suisse. He lied to the street, borrowed all this money. No one knew what he was doing. And he blew up one of the biggest and oldest banks in the world. So when they have to start liquidating, this is what happened. Someone asked me in the comments, totally legit, why is gold down? Okay, think about it. You're a hedge fund. You have so many positions. You're in everything, okay? You're every which way. And the market starts going down and you have to sell. So if you're a hedge fund and you sell and you take a loss in something, they don't like doing that because now they're locked in. They have the loss and they can't do anything about it. So hedge funds normally sell what they have at a profit first. That's the first thing that goes. So I would say there's two things with gold. One, hedge funds are probably selling their gold because it's up, and they can then offset their gains against their losses. The second thing is that the new narrative on the street is that we're heading for a recession, which I think is a little early. May happen. I have no clue yet. It's way, way too early. They only declared these last week, for God's sakes, okay? So we have no idea if we're going to go into recession, even though people are saying, now 60%. What does that mean, 60%? I have no idea. So, but the narrative is that we're going to go down into recession. So there's people who say, well, then we won't have inflation and I'll sell my gold. Anybody who follows this channel knows I don't believe gold is an inflationary hedge. I believe it is a currency hedge, a quasi-currency. That's what gold is. We can't use it in the modern world because it's not flexible enough. But we all know, we can read our history books, everybody's used gold some way, somehow, over the, whatever it is, 4,000 or 5,000 years as a means of payment, okay? So, gold is also, on the short term, I believe, going down. And as you can see here, here's the S&P and gold since 2015. There you go. Gold has outperformed the S&P for the last 10 years. So, anybody who owns gold is up. Now, people are racing out of the dollar. You saw the dollar index, 109 to 101. That's no small move. Trust me, no small move. And so you're starting to see the euro is up 1.1. The yen was up over 3. In Europe, people also don't believe in the euro like we used to, okay, like I don't anymore, but so where do they go? When you look at Europe and everything, they go in and they buy the Swiss franc. They buy the Swiss treasuries. The Swiss treasuries went negative 23 bips. The 2 year, you have to pay the Swiss 23 and a half bips to own their 2 year treasury. That's what this means. You pay them to own the treasury, okay? So this is telling you that people don't know where to go. So they're looking for what any haven of perceived safety is. And perceived safety is entirely up to whatever person's doing it. We just don't know. So is this a big event? Well, guess what? Friday was the biggest trade day shares in the history of the stock market. Over 26 billion shares traded, beating out 23.8 billion, whatever it was before, okay? So it was the #1 trading day. People, well, someone was buying, someone was selling, but 26 billion shares were sold. So what does this all mean to us? Why do we care? I would just caution people. When there's a perceived sea change in how people perceive the global economics and so forth, they rearrange their chairs on the deck, okay? And I'm not talking about the Titanic. I'm talking about where their money is, where they ate. Remember, last year, we mentioned it many times, 74% of every dollar in the world was invested in the US stock market. So imagine if they say, let's take that down to 50%, okay? So that's what's going on now. What do you think? Like and follow, and thank you very much.